Okay, good morning.
Good morning, sir.
Good morning, sir.
Okay, so we going to continue our discussions on the question and answers. So this is the second stage or phase of our question and answer section. We'll be looking at what goes into question number 2 and what goes into question number 3. So as I have mentioned to you already, question number 2 has to do with the audit of historical information and sometimes the audit of other prospective financial information or other assignment that has been given to you as an auditor. Please, let me start with the other assignment because that one is not that popular in our exam room. With the other assignment, we can be asked to audit prospective financial information, review or evaluate, or come out with audit procedures to identify evidence on prospective financial information, subsequent event review, or any other review. Please, the audit procedures is not different from the normal audit procedures. And I told you that anytime you hear audit procedures or review and evaluate, remember that you're going to apply the action verbs: read, ask, inquire, recalculate, reperform. Start with those terminologies. Anytime you are given a question on review and evaluate or the audit procedures on any item in the financial statement, the terminologies are very, very important. You read, you ask, you recalculate, reperform those terminologies, making inquiries of management and the rest. So please, if you are required to audit any item in the financial statement, you'll be reading minutes. And I told you that you can read minutes of shareholders meeting, you can read minutes of management meetings, you can also read minutes of a board subcommittee meetings. It's all about getting evidence. You can make inquiries of management around the topic. So whether it's a historical information or a prospective financial information, the same procedures. Anytime you hear due diligence, or if you are required to audit due diligence, be thinking about the financial due diligence, which has to do with the financial statement, the covenants in the financial statements, and the financial position in the company. Then be thinking about operational and IT due diligence, the operations, be checking the operations, be checking the IT systems. I told you that for due diligence questions, it's all about acquisition, it's all about investments. And before you buy a new company or you invest in a new subsidiary, you need to check their financial strength. You need to undertake operational and IT due diligence. You need to undertake people due diligence by checking the contracts of the people in a company. You need to undertake a regulatory due diligence, finding out whether they are complying with the laws and regulations that governs their activities. You need to undertake environmental due diligence, whether the activities having negative effect in the physical environment and people living in the environment. You check all that before you go ahead and acquire the company. Now, if you are asked to audit due diligence, it's about the procedures. Just raise the procedures on how to undertake the due diligence audit. It's a matter of asking questions on the components of due diligence. I told you that forensic auditors undertake investigations. And with forensic work or investigations, we don't sample as compared to a normal audit work. There is no materiality when it comes to forensic work because everything is material. Forensic work, you normally need a computer-aided techniques to support your work as an auditor when you are conducting a forensic investigations. So if you are given a question on the difference between forensic work and a normal audit, you should be able to tell the examiner the differences between the two. And in forensic work, obviously, once you conclude, you need to identify the perpetrators. So the work there is more detailed. You cannot determine the time that you're going to finish a forensic work as compared to a normal audit work where you can determine whether the work will be performed within 1 month, 2 months, or 3 months. In the forensic work, you can't determine the time scale. It's very difficult to determine the time scale because you are doing investigations, even though you are guided by time. Good. So that is for the other assignments. Now let's move on to the main thing before we look at the practical question and answer. So with the main thing, we can be asked to audit any item in the financial statement. Any item. It can be accounting estimate. It can be related party transactions. It can be borrowing cost. It can be income taxation. It can be PPE. It can be intangible asset. It can be any item in the financial statement. Irrespective of the item that you've been asked to audit, you'll be reading minutes. And the minutes, like I said earlier, are 3. You read minutes of management meetings. You read minutes of board subcommittee meeting. You read minutes of shareholders meeting. Then you inquire of management. So the inquiries of management, you're going to inquire of management around the topic. With the topic that has been given to you in the exam room, what you have to do is that you ask questions. You inquire of management around it. Then you also obtain written representation of management. Please, these are the general procedures that you can apply to audit any item in the financial statement. So please, once you have joined us, when you are given a question on review and evaluation or the audit of any item in the financial statement, you should be in a position to do it. So when the question is given to you, please, let's try as much as possible and answer it. The next thing that can be given to us in the question 2 has to do with identification of business risk. So the examiner will tell you, identify the business risk in the case study. With the identification of the business risk, or when we talk about business risk is anything that will affect the business from achieving its objective. Anything that will affect the operations of the business is a business risk. How do you identify the business risk in the case study? Be looking for 3 things, or you can group your answers under 3 things. We have the financial, we have the operational, and the compliance. Financial issues in the case study will be part of the financials. So the financials, be checking anything that relates to the finances of the business. Things that will affect the finances and the financial statement of the business that you want to audit, of your business, becomes a financial indicator, a financial risk, which is also part of the business risk. So our ability to pay suppliers, whether our key ratios are showing negatives, we are borrowing too much, and because of that, our lenders are not ready to give us money again. And because we are borrowing too much, the cost of borrowing is going up. Because if you continue to borrow and more borrow, what will happen is that the company will be highly geared. And if the company is highly geared, you're going to borrow at a higher interest rate, or the lenders will not be ready to give you money again because you are borrowing too much. And if the money will be given to you, to be given to you at a higher cost of capital. So be checking all that in the case study. Anything that relates to the finances of the company, and comment on it if you are asked to identify the business risk in the case study. And in your case, in the exam, it's so popular. So please, when it's given to you, you should be able to do it. Anything that has something to do with the finances of the company, identify it in the case study to get all the marks under the financial risk or the financial indicator under the business risk. Then the next one has to do with operational. Operational risk has to do with the risk associated with the operations of the company. Loss of key markets. So you are losing your key markets. You are losing your suppliers. You are losing your customers. Management members or key staff want to resign from the company. These are all operational issues. So be looking for those issues in the case study. It will affect the operations of the company. So link it to the fact that these issues will affect the operations of the company. So please, It's a matter of raising it in the case study, and all the marks will be given to you. Then the last one is the compliance. So government of Ghana is saying that the company is supposed to follow A, B, and C. Bank of Ghana or the regulator of the banks is saying that they need this minimum capital, but they are forcing to raise it. It's a regulatory issue, and it has to do with compliance. What it means is that if they are not able to comply, the regulator will withdraw their license and the company will no longer be a going concern. So with the identification of the business risk, we're thinking about these three things: the operational, the financial, and the compliance related issues. Please, if the question is ongoing concern, use the same points to check the indicators of going concern. So if you are given a question on indicators of going concern, it's the same thing. Because if you want to find out whether a company is going concern or not, you'll be checking the finances, you'll be checking the operational, you'll be checking the compliance. So it's basically the same thing. It is the responsibility of management to check whether a particular company is a going concern or not. But we, the auditors, we also check the reasonableness of the assumption used by management. And how do we check that? Operational, financial, and compliance, just like the business risk. And with the management of business risk, you can manage your business risk by using this term, the TARA, where the first T is for transfer. Transfer means that you can transfer the risk to an insurance company. So once you have insurance, what it means is that you have transferred the risk. Then A in the TARA is avoid the risk. So if you want to manage risk, generally, there are certain areas or certain business, when you invest your money, it's highly risky. So don't go into those businesses. Just like an audit, if you want to avoid risk, don't accept some clients. That is, if you want to avoid the risk. So you need to try as much as possible and avoid some risk. Then the R, reduce. We can also manage our business risk by reducing it. How do we reduce it? We reduce it by putting in place proper control systems. Once we have proper control systems, we've been able to reduce the risk. Then the last one is accept. So as a business, you need to accept some level of risk, because there is a positive relationship between risk and return. The higher the risk, the higher the return. So as a business, you need to accept some calculated risk to be able to move on as a business. Okay, so that is the business risk identification. The examiner can ask you to also identify audit risk or principal audit risk. David, please go ahead with your question.
Yes, sir, please. The first A, the TARA, T-A-R-A, the first A.
Transfer. So transfer, avoid, reduce, and accept.
Yeah, thank you, sir.
Okay. The next one is identification of audit risk. We can be asked to identify audit risk in a case study. Please, audit risk is the risk that the auditor will express wrong audit opinion. So the examiner can say that identify the principal audit risk, identify the assignment risk, identify the engagement risk. These are mere terminologies. It means the same thing. Okay, so the financial risk, Gideon, the answer to your question is that the financial is under the business risk. So when you are checking the business risk, all financial risk indicators is also part of business risk. Just that the business risk go beyond only financial. It's financial, compliance, and operation. Financial compliance and operation. So with the identification of business risk, audit risk. Audit risk, as I said, is a risk that you, the auditor, you express wrong audit opinion. The examiner can tell you to identify assignment risk, is the same thing. Identify engagement risk, is the same thing. The examiner can also qualify it and say that identify the principal audit risk. These are mere terminologies, mean the same thing. Okay, now with the audit risk, we are talking about the risk that you express wrong audit opinion. So what it means is that it's the risk that the financial statement will be materially misstated, and your substantive testing as an auditor will not be able to detect that the financial statement is materially misstated. So audit risk is as a result of risk of material misstatement and detection risk. Please, the examiner can also ask you to identify the risk of material misstatement. And the risk of material misstatement is inherent and control risk. So when we talk about audit risk in general, audit risk is inherent, control, and detection. Inherent, control, and detection. The three things multiplied together will give you the audit risk. Inherent, control, and detection will give you the audit risk. So when the question is given to you, just write around inherent risk, write around control risk, write around detection risk if the requirement to the question is identify audit risk. Inherent risk is the risk that is associated with the company and its operations. So by the nature of the company, they may not get certain things right. That is inherent risk. So the mere fact that the audit client or the company that you want to audit is new, management of the company may not prepare the right financial statement. That is inherent risk. The mere fact that the audit client has not been audited before, inherent risk. It means that somebody has not guided them, giving them the guidelines before. So obviously, they may get it wrong. That is inherent risk. The fact that the audit client is having a very complex group structure, inherent risk. The fact that they deal with a lot of foreign exchange transactions, inherent risk. So because of what they do, by the nature of the company, if they may get it wrong, which we, the auditors, will not be able to detect that it's wrong, it's inherent risk. Control risk has to do with the controls of the client, the experience level of management. So the experience level of management, whether they have internal audit, internal monitoring team, audit committees, and the rest. Strategies to prevent and to detect fraud. Do they really have it in the company? The controls they have in place. So just erase it. That one becomes the control risk. Then the last one is the detection risk. So the detection risk is the auditor ability to detect that the financial statement is materially misstated. So what it means is that the inherent risk can be high, the control risk can be high, but if you're able to reduce our detection risk to 0, there will be no audit risk because it's multiplication. Good. With the detection risk, number one, if the audit firm has not audited the client before, it can lead to detection risk. If you've not audited the client before, what it means is that you may really not have understanding of the industry, especially if you have not audited that very industry before. You may not have understanding of the entity and its environment. And it's very key when it comes to the determination of risk of material misstatement in auditing. The fact that the client is into complex group structure, your audit client is a subsidiary, is also an associate, is a parent to about 3 or 4 companies, and they are preparing financial statements. It can lead to inherent risk. It can also lead to detection risk because management may get it wrong, and we may not be able to detect that what management are doing is wrong. That one too is detection risk. The client is into a lot of foreign exchange transactions. It can lead to inherent risk as well as control risk, because with a foreign exchange transaction, they have to do translation from foreign currency to home, and with the translation, they may get it wrong. And when they get it wrong, we may also find it difficult to determine that it's wrong if you don't really know the IAS 21 application very well. So that is inherent risk. When they are into a lot of difficult accounting transaction related issues, financial instruments, that is what they do. And they have a lot of financial instruments. They may get it wrong and will not be able to detect that it's wrong. So please, these are the things that you need to raise in the exam room. Then we've also discussed the concept of materiality. So the materiality, we've learned that 1 to 2% of revenue item or total asset, if you are testing materiality on revenue or total asset, becomes material. If it is a profit item, we use 5 to 10% to test whether the item or the misstatement is material or it is not material. But something can be material by its nature. When it comes to transactions relating to a related party transactions, for related party transactions, what it means is that if we fail not to disclose, if it is not material to us, it may be material to the other party. And for that matter, it requires a disclosure. So you cannot say that the amount is not material. Once it requires a disclosure, we are permitted by the standard to disclose. Okay, now let me move on to the question number 3 before I come back to the question, the requirements for us to go through how you answer it. With the question number 3, it has to do with the audit reporting. And with the audit reporting, it can be reporting to management and reporting to those tasked with governance. Now, reporting to shareholders and reporting to management and those tasked with governance. When it comes to reporting to shareholders, that is where you have the standard or modified audit report, the modified audit report, and modified opinion. So with the standard or modified audit report, so generally we will start with the opinion. So anytime you see opinion, it tells you that the report has not been modified. Okay, the opinion too has not been modified, and that's the major reason why you see opinion. Because if the opinion has been modified, then the level of modification should be attached to the opinion. So for example, if the opinion is qualified opinion, the heading should read qualified opinion. If the opinion is adverse opinion, the heading should read adverse opinion. If the opinion is disclaimer, then the heading should also read disclaimer of opinion. But once you see opinion as a subheading, as a technical person, you should know that the opinion is not modified. So that is where you state that you have audited ABC company's financial statement, which include the income statement, statement of financial position, the cash flow, the notes. And in your opinion, everything shows the true and fair view, the company's state of affairs. Then after the opinion, you come to the basis for expressing the opinion. That is where you give a basis for expressing the opinion. You indicate that you have obtained sufficient and appropriate audit evidence, and you think that you have a basis to express an audit opinion on the financial statements. Then after that, you move to the key audit matters. So the key audit matters, we are talking about significant issues that you select from communicating to the communication to management and those charged with governance. You just add it to your audit report. We've learned issues of expectation gap. So we want to give users of the report more information. We want information available to management to be in a way available to the shareholders. So the significant issues from communication to management and those charged with governance, you add it to your audit report under the heading Key Audit Matters. So the key audit matters, even though you're going to discuss a lot of control weakness or some significant control weakness or high risk issues, but those things have nothing to do with the modification of your opinion. So once you raise the issue, you indicate that this has nothing to do with the modification of audit opinion. So please, somebody wants to find out when you are asked to appraise opinion. So appraise opinion means that you've been given opinion for you to appraise whether the actual opinion given is right or is wrong. So that is how to appraise your audit opinion. So if everything is okay, then unmodified opinion. Now, the next one after the key audit matters, generally you go to the responsibilities of management, talk about responsibilities of management for the preparation, responsibilities of auditors for the audit of the financial statement. Then if there are other legal reporting that you need to disclose, depending on the country, talk about it. Then the engagement partner's name and other dates and signatories will follow. Good. Now, we also have a modified or modified reports. That is a standard or modified report. The next one is where the report will be modified, but the opinion will still be unmodified opinion. So what it means is that the opinion is going to be true and fair view, but you have introduced other things in the reports. Those things are basically two. The key, the other matter paragraph and emphasis of matter paragraph. You will introduce emphasis of matter paragraph when you want to emphasize on a particular issue in the financial statement. Somebody has taken the company to court. We are waiting for the ruling of the court case. It requires a disclosure. Management have disclosed it in line with the applicable standard. But we want to draw shareholders' attention to the issue because we think that the issue is so fundamental. We will use the emphasis of matter paragraph. We have adopted IFRS before its implementation dates. So you still use the emphasis of matter paragraph. So if you state that we want to draw your attention to note number 3, which deals with the early adoption of the IFRS and its possible consequences, then you add that our audit opinion has not been modified in this regard. That is emphasis of matter paragraph. You are trying to emphasize on a particular thing in the financial statement. Other matter paragraph deals with things you don't audit currently, but you think that there is a material inconsistency in the opinion. So what you want to do is that you just comment on it in the form of other matter paragraph. So it's, for example, last year financial statement was not audited by any audit firm, or the audit opinion expressed by the audit firm last year is materially different from the current audit opinion. You want to comment on it. You use the other matter paragraph. So that is where you state that we want to draw your attention to the fact that the last year financial statement was audited by a different audit firm and the opinion given was materially different from the current audit opinion. And because it has nothing to do with the modification of opinion, we state that our audit opinion has not been modified in this regard. The next one is modification of opinion. We have 3 types of modification of opinion. Please, if you have to appraise opinion or criticize audit opinion, in most cases, the question is going to be on modification of opinion. Or if you have to form opinion, given a case study in the exam room, the question is going to be on modification of opinion. There are 3 types of modification: qualified, adverse, disclaimer. We will issue qualified audit opinion when the financial statement is materially misstated. Okay, somebody want to know where to place the other matter and the emphasis of matter paragraph. You can place it before or after the key audit matters. Okay, so with the qualified opinion, with a qualified opinion, where the financial statement is materially misstated, that is where you issue a qualified audit opinion. So that is where you have the evidence, but something has not been treated right, and you think that it is material, but not pervasive. It is only material, but not pervasive. You need an evidence. The evidence has not been given to you. You think that it is material, but not pervasive. You give a qualified opinion. And a qualified opinion, when you are writing the opinion, you use the except for. So after the heading, when you come to opinion, you will not write opinion. If it is a qualified opinion, you use the term qualified opinion. That is where you state that we have audited ABC company, which include the income statement, financial position, cash flow, notes, the accounts. And in our opinion, except for the issue that has been discussed in the basis for the qualified opinion, everything shows a true and fair view of the company's state of affairs. So that is a qualified opinion. So we issue qualified opinion. The financial statement is only materially misstated, but not pervasive. So whether you have evidence or you don't have evidence, if the financial statement is materially misstated, qualified. Now, the second one is where the financial statement is materially misstated and also pervasive. You have all the evidence, but the financial statement is materially misstated and also pervasive. The pervasiveness here has to do with where the issue is not only material, but it's also affecting a lot of things. So what it means is that the issue is more than material. Your inventory figure is wrong. Your PPE figure is wrong. Intangible figure is wrong. So it means that the issue is not only material, but it's material and also pervasive. A subsidiary that you are permitted by the standard to consolidate, you decide not to consolidate it. You're supposed to prepare the financial statement in line with the going concern assumption. You are not preparing it in line with the going concern assumption. It's going to affect almost everything. So it becomes material and also pervasive. Now, if you have the evidence and the issue is material and pervasive, you give adverse audit opinion. So where you have the opinion, you write the heading adverse opinion, and the basis for opinion will be basis for adverse opinion. So that is where you state that you've audited ABC company financial statement, which include the various components. Then you add that in our opinion, the financial statement does not show the true and fair view of the company's state of affairs. That is adverse. It's a game over. The financial statement does not show the true and fair view of the company's state of affairs. Then the last modification is disclaimer of opinion. So that is where you have been limited on scope. The evidence that you need to be able to express audit opinion, you are not getting the evidence. Without evidence, don't forget that as an auditor, you need sufficient and appropriate audit evidence to be able to express an opinion. So sufficiency has to do with the quantity of evidence. Appropriate has to do with the quality of evidence. You need all that to be able to express your opinion, and you don't get the evidence. So it means that expressing the opinion becomes very difficult. You ask of anything, they are not ready to give it to you. Flood situation, fire situation, and the rest. You don't have evidence to express audit opinion. All the documents that you are requesting for has not been given to you. Then you state that, or you give a disclaimer of opinion and state that we cannot express audit opinion because we don't have evidence. So when you go to the basis for opinion, you explain that you don't have evidence. And once you don't have evidence, you cannot express audit opinion. Now, when it comes to issues of going concern, it's all about disclosure treatment. Going concern per the standard, the IS1, requires a disclosure. If the disclosure treatment is not adequate when it comes to going concern, let's say the assumption is okay, but the disclosure treatment is not adequate, please, you just qualify your opinion, or you can even give adverse opinion. So let's say the going concern assumption is adequate, but there is material uncertainty, but the disclosure requirement is not adequate. The way it's supposed to be disclosed, it is not adequate. Then what you have to do is that you qualify your opinion. But if the disclosure requirement is also not adequate, then the going concern assumption too is not appropriate adverse audit opinion. But if the going concern assumption is appropriate, but with material uncertainty, everything is adequate, but with small material uncertainty or with material uncertainty, and the disclosure requirement too is okay, everything is right. What requires a disclosure has been disclosed. With that, you give unmodified audit opinion. And as part of your audit reports, after the key audit matters, you just write a heading, material uncertainty, ongoing concern. It's part of a standard modified audit report. It's a normal one. It doesn't mean that you've modified your report. But if the disclosure treatment is adequate, but the assumption too is not adequate, that is where you introduce the emphasis of matter paragraph. So what it means is that we can also introduce emphasis of matter paragraph for going concern when the disclosure treatment is okay, just that the assumption is not adequate or it's not appropriate. That is where we introduce the emphasis of matter paragraph on issues of going concern. Now, with the reporting to management and those charged with governance, we will report only internal control deficiencies to management and those charged with governance. Okay, so the disclosure treatment is not adequate means that what is supposed to be disclosed, it has not been disclosed in a form of notes. That is what I mean. Okay, so when it comes to the reporting to management and those charged with governance, normally we'll be reporting the internal control deficiencies, some findings on the controls that has come to our attention. We just want to report it to management and those charged with governance, even though on a broader view, ethical issues confronting the audit firm are supposed to be reported to those charged with governance, or let's say to the audit committee within the board. But with the management letter where you want to talk about the deficiencies that you have identified, normally you want to comment on the deficiencies that you have identified in communication to management or those charged with governance. So that is where you introduce your reports and tell management that, or you introduce a report by saying that you want to thank management for giving you the opportunity to audit their outfits. These are some of the control deficiencies you have identified during your audit. So you discuss the deficiency and then you talk about the implication of the deficiency and you make recommendations. That is the reporting to management and those charged with governance. Now, before we look at the requirements to the question number 2 and number 3, let me talk briefly about the audit methodologies or the approaches to perform audit work. So when it comes to the approaches to perform audit work, please, we can use the risk-based auditing or the audit risk-based approach. Please, anytime you hear risk-based approach or audit risk-based approach, what it means is that as an auditor, you identify the risk areas and you concentrate on it. That is the meaning of risk-based auditing. You identify the risk areas and you concentrate on the risk areas. Risk areas are where you think that management are likely to get it wrong. Just identify those areas and comment on it. If you do that, you have adopted the risk-based approach. The next one is the business risk method or the business risk approach. Please, the business risk approach is also known as the top-down approach. That is where you identify what is wrong with the business and link it to the financial statement. Typical example is you inquire of management whether the customers are satisfied or they are dissatisfied. As an auditor, you're going to audit financial statement. Why are you interested in whether the customers are satisfied or dissatisfied? So once they tell you that the customers are dissatisfied, Then you link it to the financial statement. So if customers are dissatisfied, what it means is that the going concern assumption given by management may not be appropriate. Number two, the receivables figure in the statement of financial position may not be correct. So that is the business risk approach, the top-down approach. You start with the business risk and you link it to the financial statement. So please know the difference between the two. Then the next one or the next method that we can use is the systems approach. That is where you check the internal control systems of the client. So once you test the systems and you realize that the systems are adequate, you reduce the test of details, or what we call the substantive testing. You don't really undertake a lot of substantive testing because you realize that they have proper controls. So that is the systems method. So test the systems. If the systems are adequate, you reduce the test of detail. The next one is the balance sheet approach. What it means is that you concentrate on the statement of financial position. You audit assets, you audit equity, and audit liabilities. That method can also be applicable. We can also use what we call the directional testing. From the double entry principle, every business transaction must have twofold effects, a debit entry and a corresponding credit entry. So once you check debit, you don't waste your time to check credit. Once you check credit, you don't waste your time to check debit. So that is a double entry principle. You can also apply what we call the transaction cycle approach. Select samples of transactions and follow up on how it has been treated and make sure everything has been treated correctly. So let's say you select 10 and you follow it up to find out whether it has been treated well. If you check and it's okay, select another 5. If it is okay, you don't waste your time to continue again. It's also part of your audit methodology as an auditor. Okay, so that is by way of summary for question number 2 and question number 3. With the questions, I've already given it to you. So let me share the questions with you. Then we look at maybe some of the requirements and we close because we have to change our time a bit because I also have another meeting. But during the discussion, if you have a question, you can ask. I'm going to read only the requirements. If I realize that we've discussed it, I'll not waste time to talk about it again. So I'm starting with the question number 2A. Identify and explain the key business risks that exist at Go Shop. So please, the business risk, we know how to identify it. I've talked about it. So you'll be looking for financial issues in the case study. And I've explained what I meant by financial issues. You'll be looking for operational issues, which I've explained already. You're looking for the compliance issue in the case study and talk about it. Just discuss that because this will lead to a non-compliance of laws and regulations, which may also affect the business to achieve its objective. This will have financial effect in the company's, in the operations of the company. It's still a financial issue. Then the B part, what is meant by business risk approach to an audit? I just explained it. The business risk approach is the same as the top-down approach. Then we are asked to identify the risk of material misstatement. It means that we're going to comment on the inherent risk and the control risk. Because I told you that we have inherent, we have control, and the detection. So the inherent and the control risk will give you the risk of material misstatement. And the detection risk is also there. That is the auditor's ability to detect that everything does not show the true and fair view of the state of affairs. So we are to recommend audit procedures to validate accounting estimates. So please, with procedures, I told you that don't worry your head so much on it. Anytime you hear the term procedures, read, ask, inquire, recalculate, reperform, just apply those terminologies and you should be able to do it. Now, with the answers given, you realize that it's too detailed. Please, I've already informed you that you are not supposed to write too much. Go straight to the point, come out with a complete sentence, and it should be fine. So this is also talking about the audit significant. Okay, explain audit procedures to audit procedures. and quality assurance issue, discuss it. But what audit procedures to consider in auditing related party disclosures, the same procedures. So you make inquiries of management, whether they are related parties, whether the related party transaction have been treated in line with the applicable standard. You read minutes of management discussing issues or significant transactions undertaken with a related party. You know, just use the action verbs, what we've discussed already. So please, when you are given a question on the audit of historical information, it should not be a problem for you at all. I have given you all the guidelines, the same procedures. We use the same procedures to audit any item in the financial statement. So if you know the standard, for example, this one has to do with IAS 24. So if you are sure of the standard, you inquire of management whether it has been treated in line with the IAS 24. If you don't remember the standard, you just state whether it has been treated in line with the applicable standard, and you should be fine. Okay. Identify and justify the type of opinion that you're going to issue. So whether you're supposed to qualify your opinion or not. So for example, if you look at this question, they were talking about inventory figure. So what you have to do is that, so the records show the cost of inventory and net realizable value, but management is not prepared to adopt the lower of cost and the net. You know, IAS 2 states that inventories are supposed to be measured at the lower of cost and the net realizable value. So if management are not prepared to do that, so what we can do is that if this is a standard issue, we check the materiality of it. If it is material, then our audit opinion is supposed to be qualified. It's just one issue. We cannot give adverse opinion. It's not pervasive. We just inventory. So we state that if management don't adjust, what will be your opinion? So you just qualify your audit opinion by stating that except for the inventory, which has been measured differently, instead of the lower of cost and net realizable value, everything shows a true and fair view of the company's state of affairs. This one we use a set for qualification. Then prepare a paragraph under management responsibility, auditor responsibility, and the auditor's opinion for the conclusion of the audit. So just talk about management responsibility. So that is where, so that paragraph, you just talk about the responsibilities of management for the presentation of the financial statement. So the management responsibility, just let them know management are responsible for the fair presentation of the company's financial statement, and management are supposed to prepare and present the financial statement in line with the International Financial Reporting Standard. Management are supposed to put in place proper systems of control. So with this, you want the users of the report to know that these are management responsibilities. These are auditors' responsibilities. So we auditors, we are supposed to audit in line with the international standards in auditing in order to get audit evidence. And what evidence are we referring to? So you talk about the sufficiency of the evidence, whether the evidence is sufficient, whether the evidence is also appropriate. Let's discuss auditor's responsibility for the examiner. Then the opinion. So with the opinion, that is where you state that you have audited ABCD company financial statement, and in your opinion, everything shows the true and fair view of the company's state of affairs. So somebody wants to know whether you have to calculate the level of materiality before you comment on it. So please, if you look at this question, we're not giving the revenue figure to calculate the level of materiality. So if it is given, if you have the profits figure to calculate materiality, then you have to do it. If it is not given, then you assume that because they are not complying with the applicable standard, the inventory figure become material. And for that matter, you give a qualified audit opinion. Let's look at where finding. Okay, yes. If you look at this very question, you realize that the revenue figure is given, profit before tax is given, and total asset is given. So questions like this, you can easily test whether the figures are material or not. Now, with the first one, if you want to test, it's just the 60,000 divided by the 54 million. The first one has to do with the lease. So you just apply the income statement figure to test whether it is material or not. Then the second one has to do with repatriation of profits. Okay. Okay, appropriate of it.
Sir, please, the first one, I didn't get you there. I'm quite confused there. The
Sheila,
first
please, your question, I can't hear you.
Sir, can you hear me?
Yes, I can hear you now.
Okay, so please, the very first one, I'm quite confused. You mentioned 60,000 over something,
Wow, I
which,
can hardly hear you. So can you please speak up a bit so that they
okay,
can
sir,
hear you?
can you hear me now?
Yeah, I can hear you. Yes, but speak up.
Okay, so please, okay, please, I wanted you to go over the one that we just solved. You said you mentioned 60,000 divided by something, which I was not
Yeah. Okay,
getting.
so please, with the materiality, if it is income statement item, you use a profit before tax. Okay, so for example, if it has to do with the income statement, you just take the profit before tax figure, you divide it by the 2.4 million times 100. So that one, if you get between 5 to 10%, or let's say more than 10%, we will say that it is material. But if it is revenue or total assets, the threshold is 1 to 2%. What it means is that if it is more than 2, it is material. So if it is a profit before tax item, we use 5 to 10%. If it is revenue or total asset, we use 1 to 2% to test the materiality level. Okay, so please, if you have questions, you can ask. We will discuss it together before I go for my other meeting. So tomorrow we will look at the last two questions, but because the last two questions has to do with government or public sector audit, which is just like one topic and a bit of current issues, we will still get time to wrap up on the 1 to 4, question number 1 to 3. So when we meet, God willing, tomorrow, we will have a lot of discussions about the general. But if you have any general question, when we meet tomorrow, please write it down. We will discuss it together. But for now, this is how you're supposed to prepare yourself for this particular area. Okay, so with peaceful man question.
Okay, sir, please, I want to find out.
You need to check the materiality before you can modify the opinion. Somebody was asking a question. Please go ahead before we end.
Okay, in calculating the materiality, is it revenue against assets?
No, it depends.
Or
For
what?
example, if you have an item like rent is in the income statement, and because it's in the income statement item, you use profit before tax. Okay. If you have an item like depreciation, it will affect income statement. It will also affect the balance sheet or statement of financial position. So you test materiality using the profit before tax and total assets. Revenue is for only revenue item. Profit before tax is for income statement items, and total asset is for statement of financial position items. That's it.
Okay.
Please come again.
Okay, I'm told that the lady wants to know the denominator is always the one you want to test materiality on. So for example, the 60,000, these are thousands and this is million. So it's 60 divided or 0.6 divided by 2.4 multiplied by 100. So that is how we're going to do the computation. And this one is going to be 1.2 divided by the total asset figure, which is 37.2 divided by 100. Okay, somebody is saying that can we go over forensic audits? So please, forensic audit is about investigation. So you're gathering data which will be used for the purpose of court. and it is used for fraud investigation, sharing of family properties, shareholders disputes, negligence that has been sued against audit firm. That is where we apply forensic audit. So Frank, you asked the questions and we are out of here. My time for the meeting is up.
Thank you, sir. Please, I want to find out. We have two figures there: the draft and then the audited. Which one are we supposed to use?
Okay, so use the audited.
Okay, sir.
Okay.
Thank you very much.
Hello, sir.
Yeah, please go ahead.
Sir, good afternoon.
Good afternoon.
I thought the lease figure is a balance sheet item. The lease is
So
a balance sheet item.
the lease can be a
Yes.
balance sheet item as well as income statement item.
This one, he's not talking about the lease interest on the lease, but he was talking about the lease figure.
Okay, so if it is only the lease figure, then it becomes a statement of financial position item.
That's right. Okay.
But lease generally will affect the income statement as well as the statement of financial position.
So we will divide it by the total
Okay.
assets.
The network is not.
Hello, sir.
Yeah, hello. Please, I have already
So we'll
attached
divide
the
the lease
solutions
by
to
the
the
total
questions.
amount.
So you can have a look at the solutions to the questions. I just wanted to give you a general background so that once it's given to you, you should be able to understand. All right, so please let me thank you and we will continue tomorrow. So thank you for joining.
You're welcome, sir.
Thank you, sir. Thank you, sir.